In the last video, what happens if the market drops 20% right after you retire? Our hypothetical retirees, John and Linda, ended up with about 54% in stocks instead of their original 60% target. But 6 percentage points, that doesn't sound like much. But what if that 6-point difference stays there for the next 25 years? Well, let's watch what happens. Okay, so let's simplify this to a $1 million portfolio. At 60-40, $600,000 would be in stocks. At 54-46, $540,000 would be in stocks. So we're talking about 60 grand. That's no longer in the equity allocation, but instead in bonds. And here's the breakdown. At first glance, $60,000 inside a $1 million portfolio may not look like enough to matter very much, but the real issue isn't the money today that's not there, it's the growth that $60,000 may no longer capture if it stays in the more conservative side of the portfolio for decades. That's where a small allocation difference can start behaving very differently over time. And in this illustration, we're going to make one simple assumption, and that is that the difference of average returns between equities and bonds is 7 points. That's over that 25-year period. Now, it's not a prediction of what stocks or bonds will earn, but we have to use a hypothetical net difference so we can isolate the opportunity cost, the potential opportunity cost of leaving that $60,000 out of the equity allocation. Let's watch what happens to that money if the equity side earns an average of 7 points more than the bond side over 25 years. Under that hypothetical scenario, the impact grows to a little over $325,000 in that 25-year period. The original 60 grand is part of that number, so the additional growth associated with the 7% return advantage is roughly $266,000. So it's not a forecast, it's just a hypothetical example showing you the difference. Now, $266,000 more, that's potentially your healthcare cost, that's a big part of your long-term care costs. Change the return difference, change the time period, and the result changes. The point is what compounding can do to a small allocation difference over a long retirement. Now, this is where it gets more important. That long-term difference didn't come from a giant mistake. It didn't come from panic selling the entire portfolio at the bottom of a market decline. It came from a 6 percentage point allocation drift that simply never got corrected. And remember how that drift happened in the first place. The market fell, retirement income was taken, and the portfolio was left in a different position afterward. A short-term event quietly became a long-term portfolio decision. And real retirement usually won't stay exactly 6 percentage points off target. Another year, it could move back the other direction. Markets change and withdrawals happen. Your spending needs obviously will change too. But if nobody is paying attention to the allocation, those small shifts, they can keep accumulating over time. And of course, we're not going to model all of that here because the math gets very complicated, but the principle is the same. Small unintended changes can quietly compound into a portfolio that behaves very differently from the one you originally designed. Now, this is not an argument that more stocks are always better. More stock exposure also increases volatility and more downside risk. The 54-46 portfolio could behave better during some market declines than the 60-40. So this isn't a choice between good and bad. It's a trade-off between different levels of growth potential, volatility, and risk. The point is that the allocation should be intentional. So it's not whether 54-46 is good or bad or better or whatnot. The question is whether John and Linda intentionally chose that 54-46. Because if their plan called for 60-40 and it was expecting the growth that a 60-40 portfolio is expected to generate, and they stayed at 54-46 for the next 2.5 decades, then a temporary market event may have permanently changed the way their retirement portfolio behaves. Small allocation changes can become long-term retirement decisions, even when nobody consciously made that decision. That's why rebalancing isn't simply about keeping percentages neat on a statement. It's about keeping the portfolio aligned with the job it was designed to do. So when you see your portfolio drift from 60-40 to 54-46, the better question isn't, is 6% really a big deal? Can I just leave it? It's, is this still the portfolio I intend to own? And if it isn't, was that an intentional decision or did it just happen? That's what I mean when I say we're trying to show you on this channel more about how retirement behaves. One decision changes the portfolio. The portfolio changes what happens next, and then time compounds the difference. Rules tell you what's possible, behavior shows you what happens next. I've seen many times in my career where once the market does decline and your allocation drifts from 60-40 to let's say 54-46, and you've went through that decline psychologically, you may be inclined to just leave it because now it's a little bit less in equities, there's a little bit less risk, you may have been jolted by the market decline, and that is a mistake. It's a mistake because it's a decision that's being driven by emotions, not logic or not what the portfolio needs to achieve its growth targets to provide income and help maintain security over the course of you and your spouse's retirement. So just be aware of that is sometimes when our emotions impact our decisions, we're simply trying to protect ourselves. And you know what? We don't want to get back to 60-40. We're fine at 54-46. Just make sure that 54-46 is still expected to generate the income that you need, the growth that you need, and be there to help you live a secure retirement over time. Okay, so far we've watched what happens when stocks fall and you still need retirement income. But what happens when stocks go the other direction? What happens if stocks rise 20% and you still need to generate the same level of income? Now the withdrawal decision creates a completely different set of trade-offs. That's what we're going to walk through on the next video.